Good morning, everyone. My name is Roger Scott, and welcome to the Big Picture with Jeff Zananeri and Roger Scott. Imagine that. We have a creative name for this and everything. How are you doing, Jeff?
I'm good, Roger. How are you?
I'm doing well. You know, I was looking at some of our positions just now. The market was down so much yesterday. It was painful, you know?
Mm.
And
They love that word. That's their favorite word, pain.
It really is, isn't it? It really is. But things are looking a lot better so far. And this is probably one of, I mean, this is definitely a time for you and I to get together and talk. We haven't talked since last week. You know, obviously this is a crazy historic time in the market. And you know, none of us have a crystal ball, but but no, all jokes aside, what do you make of this? What do you think? Are you looking at anything in particular? I mean, people at home have a lot of questions, and I want to try to provide some answers for them. So I want to get um, your take on what's happening and the impact of it in the next couple of weeks.
Sure. I feel like in the shortest of runs, we're deeply, incredibly oversold, like historically oversold. All these indexes, put call ratio, short interest, everything that people look at institutionally to tell you that we're oversold, we are oversold. However, the market can stay oversold. The market is in such a bearish way. We have a pop this morning, and I can't tell you how many futures rallies that I've seen fail as soon as the stock market opens, because there's just like this wall of sellers that people. The problem isn't just the fact that. So I like to think of the market as like an ecosystem, right? You have natural buyers, you have natural sellers, you have short sellers, you have traders that are in for a quick buck. And so the market right now went from having a lack of short-term buyers to kind of bona fide sellers, like institutional selling. So that's kind of problematic for me in terms of like what's going to create like a nice bounce here, because there are people that are looking at their portfolios right now that thought that rates would come back down, that the sell-off was a correction, not a bear market, that are looking at their portfolio from a different point of view at this point, saying, I want to preserve what's left in my account now. I can't watch it go much lower because I need this money, because I don't know what the next 2 years is going to look like in terms of my income. And so that's something that I'm, from an investment, point of view, I'm trying to wrap my head around. Typically, and I know you're a big student of market history, there aren't a lot of cases in a 1 year basis where the market's been down more than it's down right now. So from just a statistical arbitrage point of view, the downside doesn't seem to be that huge. That being said, I really hate the price action.
Let me give you my perspective, and if you think my perspective is very different than yours, then
we need perspective right now. I don't.
No.
Not now is not a time to be arrogant. I want to hear.
No, not at all, not at all. And no, not at all. And I largely agree with you, and I do agree with you for the most part, but I just wanted to give you some insight from my perspective that I've been seeing the last few days that I've kind of noticed that's very interesting. It doesn't help. I mean, it's what I'm going to say doesn't help the case, but what I've noticed is the markets at the US stock market actually started maybe even beginning of, let's see, we're now, what's today? Today's Tuesday. I totally lose track of, days.
Tuesday, the 27th.
Yeah. I would say around maybe give or take around the 20th, I started seeing the US stock market actually beginning to spruce up a little bit. And what I'm seeing over the last, that period of time has actually been more global economy pushing the US stock market lower versus
I like that.
Well,
I don't like that it's happening, but I agree.
No, that's what I said. You're not going to like what I have to say. I just have some. It's not a rosy picture.
It's not cheery, but I agree with you. I know where you're going.
Yeah. You know, like for the last.
I'm actually looking at a money link that plays on this thesis. I haven't pulled the trigger yet, but I'm looking at one that is
Yeah.
playing on
So
that symbiotic relationship.
yeah. So what I've noticed is actually like the U.S. economy, the U.S. stocks, the U.S. And we've been seeing that with the closings. You know, you've been seeing the markets actually getting a little firmer towards the closing last few days, and then you start hearing Bank of Japan, England, Europe, Asia, and I've been seeing a lot more downside roiling the open. In other words, I'm looking at the closing, I go to bed, I'm seeing a market that's firming up, and then in the morning I wake up and it's down again. So I've been seeing the downside come from global. So if I didn't think about it from perspective of institutional, because to me it's all institutional at this point. So, but you're right. But what's really bad is it's not good. It's not good if the global economy starts sinking the U.S. stock market, because up till now that's kind of been their savior. I mean,
I think that the US, I think that's why I love, like you asked me what I like right now. I
yeah,
love, I trade super short term, or I have some different types of strategies, but the type of stuff that's working for me right now is long short, my money link, like always
yeah,
having a total hedged book, delta neutral is working. And it gives me a lot of, it's like going to bed at night with, with insurance, knowing that you're going to have a roof over your head the next morning. So in this market, to not be cavalier is a big plus. I think that you're spot on with Europe causing problems. The scary part about our problem is almost like manufactured. Let me say it in these terms. Our problem is we created the problem almost out of thin air through complete negligence and oversight and really horrific management of the economy, in my opinion, by the powers that be. They were just like historically, prolifically terrible at their job, and they created a bubble on the upside, and they're popping the bubble in such a violent way,
right,
unnecessarily on the downside, that our stock market results are the result of their ineptitude more than the result of the United States economy being terrible. Europe is got structural issues that, like, you can't really believe it unless you go over there and you see it. Now, I was in the UK last summer, and I told you about this when I got back. I was in shock about how poorly run a country it was in terms of logistics, the airports, hotels, trains were even like delayed, et cetera, et cetera. I was shocked because I was used to Europe being like this, better than us in a lot of ways historically. And so for me, it was like, okay, so Prime Minister Tony, what's his name? The
Blair.
crazy yellow. No, Blair was the old guy. I'm having a brain freeze. The guy that just Boris. Boris
Yeah,
resigned.
yeah, Boris Yeltsin. Yeah,
Boris Johnson. He resigned.
Johnson. Yeltsin.
Yeah,
Yeah,
yeah.
Johnson.
He
Yeah,
just resigned, right? Because the economy was in collapse. And then this woman comes in, um, and institutes these crazy policies that puts the pound into free fall. British
yeah.
pounds in total free fall. It'd be a great time to buy an apartment in the United Kingdom for an American. But the point I'm making, Roger, is they have like massive structural issues in terms of deficit, in terms of how their economy is run, in terms of unemployment, just like structurally problematic. And a lot of it has to do with the fact that China's slowing down. The German economy is completely dependent upon Chinese manufacturing. They supply China with the heavy metal industrial stuff they need to create what they create. And so I look at the US still, and this is a crazy thing to say, even after our negligence in this stock market that's completely collapsed, as the best looking dog in in a dog pageant. Okay. Like, it's the least ugly
Yeah.
dog in the room. So
You look at
take
just
that
look
for
at the
what
U.S.
it's worth.
dollar.
Take that for what it's worth. I think we will have a recession. We're having a recession. I'm nervous because I think the ineptitude of these people is, I think we're just scratching the surface of how bad they are. I'm nervous that the economy here is really hitting the bricks, and they're looking at backwards looking data 6 months old, that by the time they realize what they're doing is wrong, it'll be kind of like they overdid it on the, how long, let's think about it like this. How long did they keep rates too low and were buying, and quantitative easing,
Yeah,
was going on a good 6-7 months, that we had
maybe.
5% CPIs in North, and they were still at zero, and they were
Yep.
still buying. So I'm going to view it like they're going to keep raising rates for 6 months past where they're supposed to. And they're already like 2 months into it. So I think 3 or 4 more months of the wrong decision making.
We're screwed if they do that. I think overall, I agree with what you're saying, and based on what as you just highlighted, what they did on the way as inflation was rising, their failure to do anything is the opposite of what they're doing now. They're trying to make up for it now. They're chasing, you can't.
But they were stubborn. They were stubborn and delayed in reacting then, which created the big problem.
Of course,
but the market was going up, so nobody complained. And now they're delayed and stubborn in realizing that the economy is already getting crushed with 6.5% mortgage rates. I mean, I'm going to talk about housing a little later. There's a structural issue that's happening in this country. That's the big thing that I'm really nervous about. But they're just operating on a completely delayed, not real time. It's almost like they're too stupid to look at market prices and figure out what's going on. I don't know, but I had hoped that there was smarter people there. You shared with me a video from Dr. Siegel from Wharton
yeah,
School.
I was just about to mention that.
It was such an eloquent way of saying what we've been saying for a year. It's nice to hear it from a really respected guy like him, but it's about a year too late that these people are saying these things. But he was also sounding the alarm in a very big way about how grossly negligent the Federal Reserve's been.
Well, I actually believe, and that's actually brings me to the topic that I wanted to talk to you about. Yes, I think they're going to keep. Okay, so I think they're just going to be stupid and they're going to keep doing what they've been doing. But I'm hoping that if maybe a few more economists like Siegel, because this guy's really top notch. This is not he's
a top guy. He's a top guy in economics. Yeah.
He's very. I used to read his material. I believe one of the people I worked with was actually trained by him. He's very well regarded, and he doesn't have a bone in this like somebody else we know. So I'm hoping that if a few more guys like that ring the bell, that it may get the attention of the Fed. I'd love to say the White House will step in, the president will step in, but that ain't gonna happen. That's just, I mean, not this dude.
You think he's gonna step in and do something good?
Yeah, right. Yeah, I
think a lot of this is a result of just like really bad leadership, like from all angles, from both sides of the aisle, from the Federal Reserve to the Treasury. I look back at 2008, great financial crisis, and I think to myself, from Bush to even Obama to Hank Paulson to Ben Bernanke, these guys all did an outstanding job in resurrecting, like Democrats, Republicans, Treasury Secretary, Fed. They were all awesome at that point in time in getting the economy back on track after what was like almost a cardiac arrest for the United States. Right now, I think they're forcing us into kind of like a cardiac arrest. Like we're raising rates so aggressively into an economy that's going into a global recession. Like you said, it's not even just an American recession. It's a global recession, right?
Yes, it is a global recession. It is definitely a global recession. And I'll tell you, Jeff, what's really bothering me is it doesn't seem like they have any checks and balances. It seems like things are really
it bothers me. There's no system, right? There's no checks and balances. There's no like recipe. It's just like one guy acting with complete discretion unilaterally. He's got his minions, his cronies. They validate what he says. I'm talking about Powell here. And I don't like that at all. If this is going to teach us anything, it's that we have to get into a much more regimented way, market-driven way of dealing with this stuff.
Agreed. So let's talk a little bit about interest rates. Interest rates obviously have been going up like crazy. Now their target now, correct me if I'm wrong, but I think it's 4.4, 4.5 at the end of the year. One of those two, I don't remember which one it is, but the 2-year rate. And do you think that's going to create a lot more havoc and a lot more derangement, so to speak, to the housing market? Do you think that I want to get your take on that?
Say that one more time, Roger. I'm sorry, I didn't catch the last part.
No, well, I know that the target now is they were like 3.5 in June, and now it's like
Yeah. Now we're near the top end of their target,
4.4,
4.5%.
4.5. Yeah, something like that. And obviously it's having an impact on it's going to have an impact on the housing market. Interest rates are now double what they were a year ago,
Yep.
almost, which is quite amazing. Rent is huge, and we don't have anything really great helping us in any of these scenarios. What do you think about the housing market? What do you think about real estate? What's your view on all of this?
So Roger, I've been called a little bit of a bear this year. I've been correct, sadly, but like I'm trying to stay even minded about it. And I think I've been preaching for people to not try to be like, calling an absolute bottom, because that's so hard, right? That's so difficult to do right now in this tape, and to keep their powder dry and keep money in the bank, keep cash on hand, have a high cash levels. I've been saying that. And but I've done some research on the economy that doesn't really have anything to do even with like the S&P 500 or the Nasdaq, and I'm seeing a secular change in the economy, and it has everything to do with the housing market. Millions of people can lose their houses, but it's an opportunity for investors because it's a secular shift in how housing operates in this country. I think you already kind of know where I'm going with this, but I've written a report, and it is actually the Federal Reserve's fault. It is actually like Wall Street's, like the way they make the sausage, the way that the industry is set up, their fault too. But it's going to affect millions of Americans who are going to be uprooted from their houses. And we're already seeing it taking place in the housing market. But they're not, sadly, but for people that are smart and that do their own research, there's a long-term investment secular shift that I think that people out there can capitalize. And I've written a report. If you want the report, it's just click on the link below and it'll be right there.
Timing is
But I don't want
perfect
to
for
give
this.
too much about it, but it has a lot to do with the shift of home ownership from individuals to large institutions.
Interesting. Interesting. That's very, very interesting.
Because whenever something happens, Roger, you always got to scratch your head and say, who is this benefiting? You know what I'm
Right.
saying? Like, they got to know that 6.5% mortgages is bad for mom and pop. They got to know that, you know, people spending 50, 60% of their income on rent is bad for mom and pop, but they got to like it. Somebody's got to like it. It's got to benefit somebody. So
Of
this report
course.
has to do with that. Follow the money trail. Think about who benefits from things. And that's how I think.
That sounds very exciting. I gotta
Yeah.
get it. I gotta read this report. Folks, please check out Jeff's report. There's a link below this video. And if you're watching on YouTube in the Wealth Press channel, or if you're looking to find it on YouTube, it's in the Wealth Press YouTube channel. You could find it below this video.
Let's go.
So Jeff, you said you kind of teased me a little bit with a money link trade. You said I reminded you of a money link trade. Did
Well,
you
I
put
haven't issued it yet, so I'm not going to get it. I'm not going to put the horse ahead of the cart. I'm going
Okay.
to issue it most likely within the next 24 hours. I'm just watching levels here very closely and wanted to see how firm the market was on open, et cetera. But it'll probably be a pro US bearish Europe trade on some level.
Nice,
Yeah.
nice.
Yeah.
Before I let you go, just wanted to ask you. Last week we had some news from Japan, Bank of Japan, and looks like they're going to continue down the same path they've been doing. They're doing the same thing and they're expecting different results. What's your view on Japan? We don't really talk about Japan much. We talk about China, we talk about Europe, but we don't talk
Japan is
about
an
Japan.
interesting country because Japan has been like they were like the original, they're the OGs of financial alchemy, because their stock market, a lot of people don't know this, it had actually peaked for over 30 years in the late 80s. Remember, they bought Rockefeller Plaza and like half of Manhattan when
And Hawaii.
yeah, and Hawaii and half
Hawaii.
of California too. When Toyota was booming and like they were exporting everything to the United States, their market actually topped. Real estate in Tokyo top still hasn't gotten back to the levels it had reached in 1989. Still not there at Tokyo. So they went into the deepest downward pressure on their economy from an asset price point of view, from a deflation point of view. It's been something that they've been structurally fighting for the better part of 30 years. So the Bank of Japan has been meddling in markets for a long time, artificially trying to create growth because they have a population that is getting old, that is not having children. The number one way that an economy and a country grows is by procreation. New kids come, you buy stuff for the kids grow up, Johnny goes to college. Johnny needs a new house after college, so on and so forth. That's the juice of economic growth, right? That's a built-in engine of growth. But these guys have been not producing at the same prolific speed. I don't know why. It's not. I'm not a sociologist, but they just haven't been compared to the West, the rest of the West. So Bank of Japan has been artificially trying to boost it by buying bonds. They've been buying bonds and they've been buying ETFs for 10 years. They've been buying EWJ directly in the market. Not only that, they've been meddling in the foreign currency markets because the dollar yen, after the euro US dollar, is the second biggest currency pair in the world. So the Bank of Japan has watched the yen collapse, like super collapse, which is great if you're Toyota, but terrible if you're trying to buy gasoline for your car or if you need to buy anything that Japan imports, which is pretty much everything that's not electronic. So Japanese people have been nervous about this collapse of the currency. The Bank of Japan's been in there buying yen, trying to create a floor in the yen, and it's still cascading against them, which is bad for the Japanese economy. It's bad for the US economy. We need more. It's bad for these big moves to happen in foreign currency in general that are one way, because what international business really relies on, Roger, is stability and visibility. You're producing a car at, 10,000 US dollars, and then you can sell it at 20,000 US dollars, and that the $20,000 you bring back into Japan will equal X profits for your company that you can pay your people and they'll be happy. Right. And as long as that relationship exists in a firm, solid way, then business has good velocity around the world. Not to be too nerdy about it, but if you have these big shocks like we've been having, it's very bad. It's very bad for business.
Yeah, it's not great, and I think what we're seeing in the U.S. is going to have a lot more turmoil and repercussions and echoing in smaller countries, because
I'm shocked that the rest of the world isn't like livid with Powell, because that's another aspect of it that he's been completely like blind and negligent about. Is like this currency crisis in the pound and the yen came on the back of the Fed, because who wouldn't want 2-year treasuries yielding 4.3% from the United States of America?
And do we really need the US dollar inflating so high? We could spread, it'd be nice to spread it around other currencies.
Exactly. But there's just like a big interest rate arbitrage that exists in the world right now, where people are like, why would I buy a Japanese bond that's yielding almost 2% less than an American one? Right. And the currency is constantly depreciating. So exactly. I don't even know what my interest is going to be worth 6 months from now.
Right.
Because you have to model for that too.
Yeah, uncertainty in global currencies is not fun, especially with the volatility we're seeing right now. Yeah.
They need to calm down. They need to calm markets down, because words do matter. Words matter. You use the word pain 10 times in a press conference. You got to calm down with that word pain. Pain is not necessarily the word you need to use, because this is all a psychological confidence game. And you're out there and you're telling everybody pain.
Good.
Pain happens. Do you want it to be that painful? It doesn't have to be that painful, but if you wish it into existence,
I'm hoping that he's trying to, time a shakeout. I don't know what he's thinking. I'm not going to try to get into that crazy. He's probably just not thinking things through and just talking. But my last question.
He's not good for the job. He's not good at it.
No, he's very bad for the job. He's awful for the job. Oh, don't get me started on him.
Historically bad. We can agree on that.
Definitely. So last question for you. Do you think there's a chance? Well, okay. What's the chance, do you think, that next round he's going to back off a little bit, or he's going to go 7.75?
That's like the $100 billion question right now, Roger. I think that we're going to have to watch. I think you're going to have to watch economic numbers very carefully. Yeah. I think these inflation numbers and the employment numbers are going to be like the Super Bowl. It's going to be like must-see TV. We got an employment number on Thursday. We have PCE, core PCE, coming out on Friday. It's not a big number before this, but the Fed watches it. That's going to be super important. CPI is going to be super important. We can't keep, if we get readings above those, if we get strong inflation data, we get strong jobs numbers, he's gonna just say, well, we got to do 75. So we're getting these relief rallies today, which I love. I want the market to rally hard from here. I think the S&P has a good 3 to 5% it can go up. I think the NASDAQ has a good 5 to 8% it could rally within within 2 weeks.
Yep.
But I think the caveat for that would be very strong economic numbers, because this guy wants to raise at 75 basis points come hell or high water. He's hell bent on it.
He does. I think that Thursday's GDP is going to be really, really important. I think they're tightening it up between 0.6 and 0.7. And I think if the spending is tight, but I agree with you. I think, so here's how I feel, just to give you my perspective. I was about 95% certain he was going to do 75. In other words, the one that just happened.
Another 75, right?
Yeah. Right after. Now I'm probably 70% about the next one. So I'm
that's
backing,
a good number. I think that's a good number.
Yeah, because I think the market's
but they have such a recency bias, man. There's such think about how hard they came out at Jackson Hole. That came out after the CPI was super hot, which was the last number they looked at, which was also a lagging number. So that's a bet that I don't want to make until I have to. If that makes sense.
No. And I think the best thing to do, is see how this week unfolds and see how the economic data starts flowing. And again, the market's going to start looking for earnings, which is the only major catalyst I see, because we're not going to get any relief.
I mean, I can't wait till we get back to a stock pickers market and we could talk about sectors, because right now it's like everything's going down and everything's going up at this, unilaterally. And the only difference between how much it goes down and how much it goes up is its historical volatility, the beta. Right. That's it.
Well, folks, I think we've said it all, Jeff. Folks, if you want to check out Jeff's report on the real estate, the state of the real estate market, who's benefiting, who's not benefiting, where the money's flowing into, I think the timing couldn't be better. I'm going to be reading it next couple of days. I think it's an amazing report. Follow the link below this video to check it out. There's no obligation on your part. It's great information. Jeff is right on topic with this. Look, interest rates almost doubled in the last year. So
I think it's going to be one of the biggest issues in the next election. I think it's too new. It's being born, but I think in the presidential election, it's going to be something everybody talks about nonstop.
Agreed. I think you're definitely doing the right thing at the right time here. Folks, check out Landlord Nation. Follow the link below. Jeff it's very, very hot topic right now, and I think you will love it. And Jeff warned you about the bear market a year and a half before anybody else did. Trust me, he's got his pulse on.
I wish I was wrong, dude.
Oh, I know, I do too.
I don't like this misery, and the,
I know you
the
don't.
worst part about it. The worst part about it is it hasn't really washed into the real economy yet. So I'm looking at these people walking around, and I'm thinking to myself, we're on the front step. We're like the infantry troops that are seeing the fire line. We're on the firing line, so we know what's going on. But I'm looking at all these people that are like, what are they talking about? The economy's and I'm like, oh man, 6 months from now,
it's going to hit people hard. The rental increases here in Florida when there's no rent control have been painful.
Dude, interest rates plus job losses. So it's like he's forcing both. He's like, I want pain. Well, how do you get pain? How do you get pain? Prices stay high, interest rates go super high, and you lose your income.
Yeah. What a guy who's running the country. I love it. Jeff, thanks once again. And folks, subscribe to this video, like this video, post comments. We gave you some really good, insightful talk. Post comments in the YouTube channel. We will respond to them. I promise. Jeff and I will respond to them. Bye, Jeff. Thanks a lot for your time.
Thanks, Roger. Be good. Talk to you soon.